I don't know. Maybe Mohamed does. The state of our early warning system on recessions relative to, for example, earthquakes or volcanoes. Are we any better, any worse in knowing?
Look, on this show, and Joe has heard me say, it's virtually impossible to tip this country into recession without a major policy mistake.
A series of major policy mistakes, not just one.
Or a major market accident. And I've never understood people who got all excited about the yield curve. This was driven by Europe. It wasn't about us. And the consumer is in a really good place. And you can't tip this economy into recession with the consumer where they are now.
All right, so how far can you tip the economy, Mohamed?
I mean, you can slow it to 2 to 2.5%, but that's about it.
But what's potential growth?
No, I agree.
So why do you need help?
Look, it was
Melissa's gesturing hand signals to me that...
I'm sorry. I'm used to being on the Fast Money Network and just sort of like wrap people.
You can wrap us.
And move
Don't be nice to me.
Don't be nice to me. No. I want you guys to say.
They tell me it's a look.
It's a look.
Yeah.
It's a look. Give us a look, Cam. I could shoot a look later on. But in the meantime, I do want to bring in Julian Emanuel, who is the chief equity and derivative strategist at BTIG. Julian's got a 3,000 price target on the S&P 500. So basically, we're dead money here.
For the time being. And in the context of where we've come from and the fact that, in our view, the Fed is likely to disappoint markets with a 25 basis point cut tomorrow, that's not necessarily a bad thing at all.
When did you get down to, I thought you were at 32 or 3,300.
If everything goes right. What we've learned in the last hour is that we're not
either or. So
we're not getting.
So now you're at 3,000 for the end of the year?
It's been that way the whole year. We've said that if things went right, Brexit, China.
Don't come back here and raise it 3 months from now. We're going to remember this.
You've got a long tail memory.
Wait, what did we learn in the last hour? What did we learn in the last hour?
What we learned in the last hour is that basically the economy, the statistics don't necessarily matter all the time when the Fed is prepared to act. This is all about a flu shot, okay? This is, a flu shot against the potential.
And about just as effective.
But you want more than a flu
32%
shot.
chance, right?
32% that you get.
So 25 basis points is maybe a flu shot, but are you hinting at you want it 50?
No. Oh, no. When we made our call, actually, you were on with us on April 1st when we made the call, and people thought we were a bit crazy for calling for Fed rate cuts. The point is that it does backstop inflation expectations. The fact is inflation expectations have stabilized since then, and that's part of what the Fed is trying to achieve. But again, you look at the data, you look at where the stock market is, you look at the fact that financial conditions are loose, more than a flu shot really isn't warranted at this point. But the markets are looking for more than that.
You've had 100 basis points of easing we talked about, which is in Fed expectations, right? If you go back to November of 2018, we were looking for a 3% Fed funds rate by the end of this year. That expectation is now down to below 2%. So is that enough inoculation? I mean, obviously, the Fed, I guess Rick is gone, but what's clear now is the sort of catch-22, and I mean that in the sense of the craziness of the book itself. If the Fed doesn't deliver the rate cut, it will require it will be a market reaction that will require the rate cut that it did not deliver.
I totally agree with that. But on the other hand, there are two things. Number one, rate cuts are only going to be so effective when you've got global trade, the rules of global trade are changing as rapidly as they are, and we've seen the disruption. The trade war has proven to be disinflationary, not inflationary, as the Fed might have expected last year. The other thing is that consumer savings rate is a very good, solid, long-term positive. The consumer is not wavering.
And I would add one more thing. Keep an eye on the dollar. The assumption was as the Fed goes dovish, that's going to weaken the dollar. But what has happened is that the Fed has opened the way for everybody else to be even more dovish, and the dollar is at near 2019.
Brexit doesn't help.
Neither Brexit nor the weakness in the EU. Right. I mean, there's a whole series of things.
I have to ask Mohamed this question because there was a great, an interesting op-ed, I think it was today or yesterday in the Journal, that said this rate cut is a risk-free option. Is it risk-free?
No, because of one concern I've had over and over again, which is we are putting in place the seeds and we are watering them for a future financial disruption. I really worry about how what's happening to financial asset prices.
God almighty.
The millennials don't get it at all, but it's a great
Not
metaphor.
Not just millennials, I know.
The Chauncey Gardner thing
is going to come in the spring.
It's going to.
You like to watch.
Whoa,
Yeah,
that's
okay.
profound.
Yeah.
We don't think the green shoots for that financial disruption are emerging yet. We think that's still a ways.
So you
into
and
the
I
future.
should judge this in about 2 years.
So it's like the vaccine. You can take it, but it doesn't cost you anything, even if it's the wrong vaccine.